Welcome to the Mr. R Show, brought to you by the Monthly Recurring Revenue Institute. If you're an accounting firm owner or manager seeking harmony between work and life while optimizing profitability, you're in the right place. Our goal? To empower you with the knowledge and tools necessary to enhance both your personal and financial well-being. In every episode, we bring you insights from esteemed individuals in the field who share their valuable expertise and practical steps. Join us on this journey as we collaborate to revolutionize your business and enrich your life.
Hey everybody, and welcome back to the Mr. R Show. As you heard in the intro, hopefully you took the time to read it, listen to it, or you just skipped over it. And if you did that, we're going to tell you about what we're talking anyways today. And as you hopefully read or listened, we are going to talk about those STR loopholes. And if you don't know what an STR is, you are about to find out. But as always, I must introduce my partner in crime. I guess it's a PIC, or maybe it's a PIT. Partner in taxes, maybe?
Gosh,
maybe we get creative.
I've been called a lot of stuff. Not that one, though, Johnny T.
Hey, at least I didn't call you a PETA. So if anybody is interested in what the PETA acronym is, email us. So,
Johnny,
anyways,
this group, I can promise you a lot of them know what a PETA is, and you probably are one of them to somebody. Oh, wait, I'm your tax professional.
Yeah, you've been stuck with me. I've been a PETA, so long time. So Chris, tell us really why we're here. And who do we bring to the party today to help us run through this? Because this might be something a lot of tax pros maybe know a little bit about, but maybe they don't have the confidence, but just haven't dipped their toes in it yet.
Well, first of all, I am so excited about today's guest. I say that all the time, but I truly, really am. I had to beg, borrow, and steal. No, maybe I didn't have to do that. But we are here to talk about short-term rental properties. And as someone that works in the real estate realm of things on the tax side, this is something that is an issue quite a bit for tax professionals. There is a lot of bad information out there. There is a lot of tax professionals preparing tax returns with some misunderstandings, and especially with the Tax Cuts and Jobs Act of 2017 and bonus depreciation going to 100%. Now we know it's phasing down as we record this. Maybe it'll come back. We don't know yet. But there was an influx of people, especially with the pandemic, moving to either staying in and then potentially purchasing short-term rental properties. And there is a significant tax strategy, tax loophole, whatever you want to call it, associated with that. So what do we do? Because on the Mr. R Show, we go out and we get the best person to educate us on this, someone that has spent a ton of time educating her peers, someone, in my opinion, this is my own personal opinion, is the number one STR tax professional in the country. So Natalie Kolodij, welcome to the Mr. R Show. How are you doing today?
Awesome. Thanks so much, Chris. Thanks for having me. And I am doing fantastic.
We are thrilled to have you, and we're going to talk through short-term rental properties. We are going to hopefully until the end, refrain from breaking down Schedule C or Schedule E or any of those fun things that you have to battle on a weekly basis, I'm sure, with people. But we don't want to spoil anything. We're going to start slow, and we're going to, first of all, ask you a little bit about yourself. We met through our association and teaching with the National Association of Tax Professionals, and I met you in person at Taxposium in 2023. Went to both your sessions. Was extremely impressed. But tell me a little bit about yourself and how you got into becoming a tax professional, becoming an EA, and then falling into the niche of real estate.
Yeah, absolutely. So I got into tax the standard way, or I think one of the most common ways, which is I went to school for 5 years, and I was on the CPA track. I ended up in accounting on accident. I had a professor write the average salary of a business major versus an accounting major on the board, and I said, oh, well, I can do that if that's the difference. And then when I got out of school, I started working for CPA firms, and it was the same time I got into real estate investing. So the two just ended up heavily overlapped for me. So as I was learning about real estate, I was also helping investors answer some of their tax questions, and it just kind of grew into a really specialized area for me. And then I ended up getting my EA license because I started my own firm and I got buried in work and I don't do anything on the audit side, so only tax. And so the EA credential made sense for me. And so I've had my own firm now since 2017, working exclusively with investors. And then a few years ago, I started teaching as well. Like you said, we met both instructing at Taxposium. And so that's been my focus for the last few years is tax education.
That is really neat. I mean, it's funny to have you started investing in real estate? I know the answer to this, but personally, and can you tell us a little bit about some of the good experiences, bad experiences, and if it helps you work with clients and other tax pros that run into real estate?
Yeah, absolutely. So I've had good and bad with real estate. I think anyone who invests in it has. I got started in it in the worst way you should start or could start, which was I paid for one of those like weekend guru seminars. So don't do that. But then the flip side was I was pretty driven to actually go and do something to make back the money I spent on this nonsense class. So I got started in real estate by flipping mobile homes. I was renovating mobile homes in parks and then reselling them on owner finance. So I did that for several years in Seattle. Now I've moved on to buy and hold, and I typically do midterm rentals. But there's been all kinds of unique road bumps in between, and I would say most of them involve contractors in my experience.
Well, that's funny because John, our co-host here, little known fact, although a marketing guru, also has his general contractor license.
So is that most of the angry emails?
He's been renovating an old property in Michigan, his primary residence, and I get to, even contractor to contractor, I get to hear some of the headaches that you go through there, Johnny T.
Oh yeah. That's, not to get in the weeds too much with that, right? But I've heard it a lot. Not being a tax pro, that's actually what keeps people out of dipping their toes into it or trying it, is just the fear of, who do I turn to if something goes wrong? Because you can't, the thought, right? I think, we'll say society in general, AKA cable TV and YouTube, have made the flipping properties seem like it's extremely easy and profitable. But in fact, it's actually the opposite of both of those if you don't do it right? And I think that, obviously keeps a lot of people from it. So I find it very interesting that both of you have found in your private practices have found that niche with real estate investors. Obviously, a lot of them being more hands-off and some, being more hands-on. But then, obviously in comes STRs, so the short-term rentals. And, Airbnb has done a fantastic job of marketing throughout the years. I got a story about that. I won't share here because I think we did on a previous podcast. But just how they have made it more normal to stay in somebody else's home instead of a standard hotel. So I'd love for you guys really just to maybe get into it and start us off on that foot again for somebody who's not too familiar with them. Maybe draw the lines and really define those. What are short-term rentals? What are they not? And just some experiences maybe you guys have had from the tax pro side.
So for me, a short-term rental is anything under 30 days, but most typically it's a week or under for the average guest stay. And it comes furnished. You're not having to bring in all your own furniture. You can typically just show up, make yourself at home, and it's an alternative to a hotel. On the tax side of things, it gets a little complicated because there's sort of this very gray area outside of some standard terms we have. So as Chris was mentioning, they absolutely blew up in popularity. I think we had 200,000 new short-term rental listings on Airbnb from 2019 through the end of the pandemic. And all of those people now had tax returns to file for their new listings. And that's kind of where we had to dive into things.
Absolutely. And one of the things Natalie mentioned is with the IRS and, what does the IRS consider a short-term rental property? Because I know there's confusion out there. There's almost fist fights at these tax conferences because there's kind of two definitions. There's the 7-day rule, there's a 30-day rule, and there's those substantial services. And I would agree with Natalie. The vast majority of short-term rental properties are the week or less average stay. So what is, for as a tax professional, what do we consider a short-term rental by definition? And I'll finally add in there that Natalie, I know you're on Bigger Pockets, and a lot of people that are in this space and in some of these other forums, there's these midterm rentals. But midterm rental doesn't, last time I checked, isn't in the tax code.
Yeah, neither is short-term rental. That's what made this such a fun few years, was trying to pair up these non-tax words with what it actually means for our world. So on the tax side, for me, short-term rentals typically, so like you said, there's short-term, mid-term, long-term, and the tax code doesn't define either of those, short or mid, but what it does say is what isn't kind of your standard long-term passive rental. And so it goes on and on and on. The tax code's big on telling us a whole bunch about what something is, and then in like fine print almost at the very end, there's these except for blah, 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 blah. So after it goes on to tell us all about what a rental is, it says, oh, but it doesn't count if the average guest stay is 7 days or less. So that one little caveat is what we can use to kind of define a short-term rental for tax purposes, is just where the average guest stay is 7 days or less. And then you mentioned midterm rentals. So those aren't specifically excluded in that same category, but like you said, when there's services. So if you start adding services in, substantial services, anything 30 days or under with substantial services can also technically fall out of that standard what is a rental definition. So there's kind of a lot of wiggle room and circumstance you can control to see where your property is going to land.
There is a lot of wiggle room. The IRS came out, or not came out with it, but it's been there for a while, and identified what they say are substantial services, which still is a lot of gray area in my opinion. And just my personal opinion, I'd love to hear yours, and it might be different, but I find it very difficult for someone to provide substantial services if they don't live in a very, very close proximity to the properties that they're managing.
Yeah, and it's kind of interesting. So there's two different wordings we use in the tax code. So in what's a rental and what's passive, it says personal services. I forget the first word, but like expansive personal services. I'm blanking on the exact definition. And then when we look at what is a business that pays self-employment tax, it says substantial services. And we tend to use the terms interchangeably because they tend to be one and the same. And where this gets mixed up, and this is, for me, the hill I will die on, and I agree with you, Chris, I think it is very rare for a rental to meet this level of substantial services, but it has to be a service occurring while the guest is there that has a substantial value. So not just like a mint on the pillow, that wasn't worth anything, but something of a pretty decent value and that occurred during their stay. A verb, there has to be a verb. If the verb didn't happen while the guest was renting the property, we don't have a substantial service. So doing a service in between guests is just standard operations. If you're just cleaning in between people, you do that on long-term rentals also, not a substantial service. You have to be doing stuff during the stay, maid service, fresh towels, cleaning the room daily, meal delivery, room service, all of those kind of activities.
Right. I always use the example, and now I'm a little older than you two, but Mrs. Garrett, she was what was that name of that show? It had Tootsie on it. Oh, I'll think of it. But anyway, it was, she had like almost like you have your own Airbnb. You live there, you cook the meals, you turn over the sheets, you might pick someone up from the airport, you might take them to a wine tasting personally. So it is very rare that someone meets that level. And I'm glad you pointed that out. So, as far as substantial services, something has to meet substantial services or substantial personal services, and those are two separate terms. So there's two things we're talking about, right? There's the Schedule C versus Schedule E. And what we're saying is you have to meet substantial services to get to Schedule C.
Yeah, so where it comes into play is for two different things. One is whether it is passive or non-passive. And the other is when a rental moves from Schedule E to Schedule C. And so from E to C is where we look at those substantial services. So even if a rental is 7 days or less, even if it's non-passive, even if anything else has happened, unless they are providing those substantial services, it doesn't move to C. The reason being is that the only time the almost only time a rental property pays self-employment tax is when it is providing those substantial services. And the only time activities really go on Schedule C is if they're paying self-employment tax. So unless you have both that short stay of 7 days or less and those services, your rental should almost never be on Schedule C.
Correct. And yeah, there's a lot of, we get a lot of, and it's fine. There could be pushback, but it's very, very rare. Now the 30-day rule, which is provide 30 days, so when we're talking about is a property a short-term rental property, it's the average stay is 7 days or less. In average means typically like more than one if you have an average, but again, sometimes people squeeze in right at the end of the year. Or 30 days or less, and you're providing substantial personal services. So is that, and that's the verb during your stay? Am I understanding that right?
Yeah, correct. So I was trying to find the exact wording because it's not substantial personal services. That first word's slightly different.
Okay.
And I can't think of it offhand.
That's all right.
But yeah, if you are 30 days or less, and because they're almost one and the same is the thing. If you have substantial services, you almost always have the personal services definition. So if you're 30 days or less and providing services in line with like a hotel or a bed and breakfast where you're cooking meals daily, shuttling them to and from the hotel, all of that, then it might also be on Schedule C. So either way, it has to be that level of service verb during their stay. And that's where we start looking at Schedule C and also paying self-employment tax.
Right. And I see this a lot of times. One of the strategies a client or a taxpayer can use, which I think is a pretty good strategy, is maybe that first year you own it. Because there are some markets that you could have a snowbird in the winter. And, if you accept a snowbird, obviously financially, we say don't let the tax tail wag the dog, but, financially it's nice to have that rent in there. But if you have someone that wants to rent, let's say, all of December and January and February, you can really muck up your average rental days pretty quickly. So people should be aware of that. Have you seen anyone run into that situation?
Oh, yeah, absolutely. So that 7 day or less rule is an average of all the separate stays during the year. And so I've seen it where people will do exactly like you're saying, like, oh, we'll just rent it to one guest for the off season. Or if they switch over a property, if it was a long-term rental and in June they hear about short-term and they're like, oh, I'm going to switch it over. Well, now you've got 6 months as one of your stays. So your average is going to be skewed substantially. But the cool thing with short-term rentals is all of these tests we talk about are an annual test. So they're almost like a chameleon. You can kind of choose whether you're going to pass or fail them in a year. So you can choose whether it's a passive or non-passive rental. You got a little bit of a planning opportunity.
Absolutely. And especially for someone that maybe it's year one of the property, they're putting a bunch of time into it, get it prepared, get it turnkey. Maybe they rent it out starting, in October. They do short-term, 7 days or less. They're self-managing it, and they meet the short-term rental loophole that first year. And then the second year, you're right, they could intentionally not pass the test. They could turn it over to a property management company and say, my significant other and I don't get along trying to manage this property together. So we're going to, for the sake of our relationship, we're going to turn it over to a third party. Or that property's moving and I'm going to move it to a third party and I'm going to go buy another short-term rental property. And I've seen people kind of stack that as an annual tax plan. Again, don't let the tax tail wag the dog, but I've seen that happen also. So that's a great point that you say it's really an annual test.
Yep, absolutely. So you can kind of choose back and forth. And as you mentioned, you can do it towards the end of the year and it still counts. I typically recommend 2 or more stays because you can't average anything under 2. So if you can buy it and get it in service by year end and have those 2 stays, you might only need to deal with managing it for 1 month. There's just going to be a single month that your wife's mad at you. And then in January, you can do whatever you want with it, but you've got to just make those one. There's no clawback if you change your mind the next year. So as long as you can meet that definition, even if it's only in December, you're ready to rock.
I agree. And that's where it gets tricky. Obviously, there's some aggressive tax preparers, there's some aggressive taxpayers, and we've all run into them. We're not going to dive into them too much on a podcast. That's not a smart move. But the thing is, I agree 100%. To have an average, you've got to have at least 2 stays. You could potentially argue 1 stay, but I could tell you this: nothing divided by 0 is an average. So it's very difficult to substantiate that you have a average day of 7 days or less with 0 stays.
Yep, absolutely.
Couple thoughts. So when we talk about passive versus non-passive. So you touched on that. So I think we have a good idea of what is a short-term rental property. I mean, that's the first thing, because the stays do matter, the average stay. And you did touch on, when does something go from passive to non-passive treatment? What's that kind of trigger?
Yeah, so for your normal long-term rental, they're passive by nature, which is great. It means if you make money, you don't pay self-employment tax on them. The downside is if you have losses, there's a lot of limitations on when you can use those losses. So by moving something to non-passive, we don't have to face those same limits. So that's a huge benefit. And as we mentioned earlier, the first thing is you need to have that guest stay be an average of 7 days or less. But then the second part to getting to use losses from anything really is you need to have material participation in that activity. So if we can hit these two triggers of 7 days or less and where the owner or taxpayer materially participates, then we can change that over to being non-passive and circumvent those standard income limits.
Right. And so just like any other activities, could be another rental property, could be a business. To deduct losses, you have to have material participation. We know that there are several tests for material participation. What I found 99% of the time on short-term rentals is that the material participation test that they're meeting is the 100-hour rule, which, can you touch on that a bit?
Yeah, absolutely. So for material participation, there's a list of 7 tests. You can use any one of the 7, but most of them are pretty obscure. So the most common ones are 500 hours in a year or 100 hours, but more time than anyone else. And this gets tricky because it is hard enough to get clients to track their hours, but now they also need to track the hours of their cleaner or their property manager or whoever else is putting in time on that property. Now there's a number to beat and you need to find out what it is.
Absolutely. And that's the responsibility of the taxpayer. We can put in the show notes some recommendations. I know, Natalie, we're going to put all your information. You have some amazing resources, that you put out and have I think you have a sample hour log out there that we can, and some guidance. As far as the hours, the 100 hours versus the 500 hours, it seems like it's pretty hard if you're using a third-party property manager, it's pretty hard to say that you're putting more hours in than somebody else. Some people might argue they are. Could you give us an idea of, what hours in general, just general hours qualify for this? Because I know a lot of times clients or taxpayers ask about, do my hours before I buy the property potentially count? Do they start counting when I buy the property? Or do they only start counting after the property's placed into service? Which I'd love for you to touch on that just a little bit, what that means. And then sometimes, especially I'm a resident of Tennessee, we get a lot of people that buy in the Smoky Mountains and travel there. So can you kind of give us some guidance on, not to get in the weeds too much, but what hours count in general?
Yeah, so for those hours for material participation, it's typically going to be any of the hours required for the day-to-day operations. So if you are meeting with tenants or meeting with contractors or doing work on the property or hiring people to do work on the property, all of this sort of standard operating time will count. Another cool thing with material participation is if you're married, you are allowed to combine hours with your spouse. So if you're trying to hit 500 and you each spend 250 during the year, maybe it's a huge beach property, so it takes a lot of time, then you're good to go. You can combine them. Hours you can't count are going to be your investor hours. So I don't want to hear that you were home looking over financials for 4 hours every Sunday. We don't get to count it. We can't count your education hours. So if you're taking a class on how to better run your short-term rental, we're not taking that. Also, any of your pre-purchase hours or time, like searching for properties, I hear that a lot. Like, Natalie, well, I spent 2,000 hours last year looking at houses. Like, okay, yeah, I spent 2,000 hours watching HGTV, but we're not counting it. Like, it has to be on your property. So it has to really be day-to-day hours. And one of my favorite hours you cannot count that people have tried because it made it to a court case is your on-call hours. If you are just sitting around because there's a chance a toilet might break and you might have to go work on it, those hours also do not count.
You're not a firefighter that you're getting paid to be on call for 24 hours. It does not count. And random side, there's been some very interesting house hunters lately. That's one of those shows my wife and I really love. This is hopefully a PG one, but for the first time I saw, you might know what I'm talking about. There was a nudist couple looking for property in Florida, and they actually did an episode on it and just blurred out certain things. I thought it would never make it to House Hunters. I thought it was hilarious.
I hadn't seen that one.
They're driving around and the guys are like, people are cutting their lawn. But the thing is, they toured the properties completely naked. They're sitting on the people's couches talking about it. The whole community is clothing optional, where like even everything was. People cutting their lawn, they showed people playing pickleball. John, we're not going to get into pickleball today.
How do you test those properties, right? Like you're like, let's just walk around and see how the breeze is going. Like, what's that?
Yeah, we would have no listeners. We'd have no followers with me on the show.
That's where you find paint where paint doesn't belong. Just and for everybody, a little disclaimer, right? So everybody that's listening to this and obviously not watching it, this is not a clothing optional podcast. For the sake of Natalie and Chris, I promise you prefer it this way. So anyway, and honestly, like Natalie, you mentioned this a while ago too, which I mean, we don't have to go too in depth on it, but I guess it really does boil down, a lot of the, we'll get into the short-term rental loophole specifically, but just for short-term rentals alone, really, and I'm not going to take it verbatim, but how I wrote it down here is it actually presents a lot of planning opportunities, right? So I think the big thing, right, is obviously knowing what opportunities there are. And as in the teaching tax flow side of things, I mean, me and Chris are always talking about a personal board of directors, which if anybody's not familiar with that, who's your tax pro, who's your attorney, who's your people, basically. And having everybody kind of ready to roll or be the resources for all those questions. So maybe even talk to us a little bit about the planning opportunities as much as we want to go down that hole, but then also too, just, how a lot of other people get into these, right? Is it something that is presented possibly to a potential client? Say, oh, you know what? We're talking about tax planning. Have you considered short-term rentals? Or are a lot of them now coming to you saying, hey, I have this short-term rental. What in the living beep do I do with this thing? I'd love to hear what your day-to-day is and some of your experiences there.
Yeah, I think we're seeing more of both now. For a while, it was really unknown. And I think this is where a lot of tax pros got sort of the wrong idea stuck in their head of where to report it and how to report it, because we didn't see it a whole lot. But it became more and more popular because short-term rentals tend to cash flow really well. And during COVID, we couldn't fly, so people were staying local and renting a cabin with the family. And so when things get popular, the internet ruins them. And so then what happened was it was all over social media, which was great that people were learning about it, but they would learn like the tip of the iceberg. So they would learn 30% of what you had to do. So a lot of people got into it for either the cash flow or hearing about tax benefits, but not really understanding what they were or how to get them. So it's been a little bit of both, but it is something that we also implement and suggest pretty often as a strategy. If someone is investing already, or they've got short-term rentals, or they're considering short-term rentals, it can be a huge determining factor because there is a ton of tax planning with it. There's very few ways you can shift your income by, 6 figures in a single year with just a little bit of planning, and not anything that's really that complicated, but that's sort of lined up with what you were going to invest in anyway.
Right. I mean, Natalie nailed it. I mean, this is a great opportunity for planning. And there are a lot of people that there are more restrictions with what can be a short-term rental and what can't be, as far as from like a local government perspective. But, a lot of we've seen people convert former long-term rental properties to short-term rental properties. And the fact that you can, combine the hours or you can have one spouse, typically the fact pattern, you might have one person that's maybe a higher W-2 earner. The other person might not, maybe they work part-time, or they don't work and they really manage the property, and they can offset that high W-2 wager earning and still have something that produces income. And I really like the breakdown of just mentally thinking about the hours, we're talking about those hours counting of investor hours versus, operational hours. And maybe that's, another thing with a lot of times, like Natalie, you mentioned you took that guru course and wasn't the best of experiences. I think, but a lot of people will just think, that's 40 hours right there because I drove to God's green earth and sat in a conference room for 40 hours. And that's, those are investor hours, I guess you could say. I do want to touch on something really awesome that you said, that those operational hours start once you close. Because a lot of times, depending on some people like buying turnkey, but some people like buying a value add property. So once they close on that property, the hours they put into the remodeling and the decor and those, just to confirm, those are gonna count, even if the property isn't placed into service right away, right? Available for rent. Is that correct?
So it's going to be a little bit of a gray area. I think if we didn't count those hours, that almost no one would qualify. I think this is where most people get their time, is that setup that first year. But from a pretty technical standpoint, like if the business isn't opened yet, it's hard to count your time in it. But there's sort of some back and forth on that as well. So I will typically include those hours, but I would just say try to be a little bit cautious with those, a little bit conservative. If those are sort of the icing on the cake for all of your hours, great. Try not to have that be 490 of your 500 hours maybe, just to make it, yeah.
And what I've seen too, sometimes people that are pretty savvy, they might buy a property that has existing reservations on it that still needs some work. They might honor those reservations. So really they're buying something that's already in service, and they might take a pause on it for a little bit and do those value adds and then put it back on the market. I've seen that utilized as well. So there's a lot. The point is, there's a lot of planning opportunities for people in this space.
Actually, Chris, I never thought about that. Here's a question a little bit different for both of you, but related to that. Chris, since you mentioned that, if somebody, this is kind of related to this, but not really, more of personal interest. Say I have a short-term rental, it's January, and I'm booked out for the majority of the summer or the winter. Have you guys ever seen it where somebody has sold a short-term rental, but also taking into consideration, the revenue that's on the books? Obviously, that's part of the value of it, but it's like a business, right? Like you're not selling accounts receivable in a sense, but I don't know. I don't even know exactly how I'm asking that, but it's just it's interesting. Like, does the future bookings that you already have reservations for add value to the property more than if you just, like an appraised value? Technically, because it's more of a business?
What I've seen is it depends. Like a lender is not going to care if you're doing a traditional home loan on it. But from a just fair market, what someone's willing to pay, if you can show that you have those consistent bookings, it might have more value to someone. But if an appraisal can't meet that amount, it's not really going to help you either. And if they're through a platform like Airbnb, they won't transfer them typically. So there's a lot of kind of caution with what you're buying, because mostly you're just buying a house. You got to remember at the core of what you're buying is a house.
Yeah, what I've found is most the bookings don't transfer. So what typically is going to happen is the person buying the home, if they want to keep the bookings, it's in their best interest to have some type of transition and try to reach out and honor the prices, cancel the reservation, and then rebook it. And maybe they give them the same price, hopefully. And that's the challenge too when you're, when you're renting. How many stories have we heard from friends and they're like, hey, 3 weeks before I was going to go on vacation, my booking got canceled because the property got sold. It happens. Now, from a tax perspective, I don't know where Natalie's mind is, but I'm already thinking, do we have recapture? Do we have a potential 1031 exchange? Are they going to, what's going on with this property? So,
well, thank you both for responding to that. I'm kind of proud of myself. That's the dumbest question I've asked all day.
Well, good. Congratulations. I'm going to send you a trophy for that one.
Right. Yeah. No, thank you. And it makes perfect sense, Natalie. Thank you for your description. And Chris, obviously yours too. So you're right. So I wasn't sure about that, if Airbnb or Vrbo actually transfer those. So really in a case, maybe it's easier if it's, you're doing private bookings through your own site and you're managing it, obviously more hands-on.
We talk about this as a short-term rental loophole, and we haven't even talked about the biggest elephant in the room to make it the point is when you have a short-term rental property that meets what we call the short-term rental loophole strategy, and it gets non-passive treatment, the losses from that property are not considered passive losses now, and they can offset other types of income, most likely W-2 wages, maybe even retirement income, self-employment income, although not self-employment tax typically. But to do that, typically you're going to have someone come in and look at the property and do what's called a cost segregation study. And what that means is that someone's going to come in and instead of depreciating the property over a straight line basis, they're going to identify the 5, 7, 15-year asset class properties. And man, there's a lot of strategies with that, not only for properties that are placed into service in the current year, but potentially properties placed into service in prior years. And I know, Natalie, you do an amazing job working with clients that might come to you and they might have properties that they've been operating as a short-term rental since 2020 and never did a cost segregation study. So in that case, so other tax pros understand, is that a strategy that could be used only in the year they place the property into service, or could they potentially do a cost segregation study in a subsequent year? And what kind of, what kind of adjustments, and, maybe we touch on the 3115, the 481A adjustment, what kind of considerations would you have with that? And then I think a lot of people get tripped up, and then I want to really hear from the master on the property. How many times do you see them as a 27.5-year asset as a short-term rental? It kind of drives us a little batty. And how should we fix that? So I know I threw a lot at you, but this is really interesting for the tax pros.
Yeah, so we do a lot of cost segregation studies. And as you mentioned, it separates out assets into those shorter classes, which is allowed. It's more accurate, actually, because when you buy a house, mostly there's a lot of other stuff with it, right? It comes with floors in it and appliances and ceiling fans and all kinds of things. So it's having an engineer separate them out. And then what's cool is instead of, $100 expense getting spread across 20 to 30 years, if we can take it across 5, your annual write-off is so much higher. The kind of counter or next step to that is bonus depreciation, which we've heard in the news a lot lately. It might be going away. It used to be 100. Now it's dropping down and phasing out. But bonus depreciation says anything with a life under 20 years, we can let you take a huge chunk the very first year. So this is what kind of created this loophole, was it gave us an opportunity to buy a property, rent it 7 days or less on average, materially participate, and then that year you do this bonus depreciation after your cost seg and have a huge loss for that first year. And this was a tremendous planning opportunity. With bonus depreciation, the cool thing is it's based on the year the property went in service, not the year you do this study. So anyone listening, if you have clients who have short-term rentals or where they might need rental losses for any reason, but if they have a rental that was put into service between 2017 and 2020, they still qualify for that 100% bonus. It's not too late. It's based on the year it happened. And you can do a cost segregation study at any point. So even if they put that rental in service back in 2020, and this year you decide to do that study, you can absolutely do that. And then the difference is you don't go backwards. We can't amend. You are going to do the study, figure out the difference in depreciation, what your amount of loss would be, and then creates a 481A adjustment, which is basically going to be your extra expense for the current year. And in that current year, you're going to file Form 3115. That's a change of accounting method, saying we're changing from straight line on a whole house to breaking it out into all these other little things, and we want to take this adjustment. So there's not a cutoff for when you can do it. I will say the longer the property's been rented, sort of the value of the study starts to go down because you've already used up chunks of that depreciation. But definitely if it's been 5 years or less, I would look at it. And with considerations, so any tax pro who's done a 3115 knows it's not the most fun time you've probably had. I think the instructions say it takes 28 hours or something to complete that form. So if you do the cost seg in the very first year, you don't need that form. You're setting it up broken out to start with, which is much easier. If you do it in a later year, you need the form. The biggest consideration for me is during which year will it best benefit the taxpayer. So if it's the first year right now, and it would be easier to do the study, but we know 3 years from now they're going to have a huge gain on something and a big loss would be really beneficial that year, we might want to wait a couple of years and make sure we meet that short-term loophole in that big gain year instead.
Absolutely. That's a tax planning tool. And I feel like I love cost segregation studies as well. But what really irks me sometimes, and when I'm reviewing a tax return, especially if we're just doing a tax planning engagement and we didn't prepare the return, is that someone has a cost seg study with a $250,000 loss and their W-2 wages are like 150 or 200. And now they just have an NOL that they're carrying forward, and they ultimately wiped out a bunch of income at a very low marginal tax rate. And I think to myself, man, maybe they should have elected out of a portion of that, bonus depreciation, or maybe they should have done a Roth conversion if they have those dollars in 401ks and let that grow tax-free. So the cost segregation study that Natalie's mentioning is a great tool, and it could be used with other tax planning opportunities in concert with it. One thing I think that a lot of tax professionals get tripped up on is if you have a residential property that's a short-term rental property, what would be the default depreciation time frame on that?
Yeah, so by default, a short-term rental is 39 years and not 27 and a half, even if it's a single-family house. And this is the fact that all but gets tomatoes thrown at me when I teach this at tax conferences, because it is very upsetting for tax professionals. But the reason being, like I said, with short-term rentals, almost everything about them is an exclusion. It's but it doesn't meet this criteria. And for a property, for a building to qualify as a residential rental, 80% or more of rents have to come from rental of a dwelling unit. Then there's an exception that it doesn't include units that are used where more than half of them are on a transient basis, which is typically 30 days or less. So even if it's a single family house, if your average guest stay is that 7 days or less short-term span, you are going to be on a 39-year depreciable life.
Mm-hmm. And that's I see that all the time. And then this kind of ties into the next question you've talked about on your podcast, which we'll put a link into, which is amazing. But if as a tax professional, and let's say you're looking at a tax return for a potential client, and you feel like a cost segregation study would make sense. When would you amend the return versus just file it as a 3115 the next year? And I agree, pairing that cost seg with their highest marginal tax rate year is a good tax plan. But when should they amend a return? I, like you, love tax extensions. We won't go down that rabbit hole for many reasons. Versus when they would do the change of accounting method the next year.
Yeah, so if you see someone where last year they just bought a rental and it was a short-term rental, and you can run the numbers and see it, cost segregation would have been a huge benefit to them. If a depreciable item, either like in this case, something that would benefit them to change, or if something was incorrect, if it's only been on 1 year's tax return, you are allowed to go back and amend, because you haven't established a method yet. You have to report it 2 or more years to kind of show this is first year could have been a fluke, second year you're yeah, no, we mean it. As long as it's only been 1 year, you can either go back and amend or file that 3115 in the current year. So another kind of planning choice there, what year would be better? If it's been on 2 years before it gets to you, you have to do a 3115. I know it sucks, but you cannot amend anymore. We do not have the option. The only time you can is if it was also sold already. So if the property was gone on 2023's return and it comes to you and you're wait, you didn't claim depreciation, you get to amend it if it's the final year it existed. But otherwise, 2 or more years and you have to do a 3115.
Right. And can they amend a tax return? Let's say it's someone bought something in 2023 and they had their tax return prepared in March, and it's July of 23. It was the first year. Could they go back and do a cost segregation and amend 23? Or they can do the adjustment in 24, basically.
Yep. Anytime up until 24 is filed, they're still in the clear to amend.
Well, that is good, really good, because there's a lot of confusion out there on it. And the good news is most cost segregation study companies that are very reputable are going to help you with that 3115 forms. A lot of them prepare it. You might have to either attach a PDF, or you might have to re-put it in your tax software. But definitely, having that prepared by the cost segregation study company does help quite a bit.
Yep, absolutely. I will add a little caution for tax pros, which is the DIY cost seg studies where people can go online and do it themselves. I've had 2 colleagues who had those just thrown right out in audit recently. So they're not even considering that that's a valid reason if it was created by a computer software. And on top of that, even with the full firm studies, right now they're looking at them pretty close. So something that I don't think a lot of tax professionals realize is if you have a cost seg firm do a study and your client comes to you and you set it all up based on those numbers, you still need to look over that study and make sure you agree with what is listed as 5-year, 7-year, 15-year. If they picked something that was obscure, it is a stretch to call it 5-year, it's on you if you sign off on it. So I would add the reputable firms normally nail it. There's no questions, but definitely take a look over it now because we've had an uptick in auditors looking at this because it's a huge tax benefit. They're losing money, so they want it back.
Absolutely. And most, the reputable firms are going to stand by their work and they are going to offer the representation assistance or audit protection or whatever they want to call that. I agree. The DIY stuff, I mean, when you're talking about, hundreds of thousands of dollars of deductions, it's worth it to make that investment,
Yep.
So yeah, I would say a couple more questions for you, and just really thinking about the questions I get from practitioners and people that listen to the podcast, cautioning, maybe helping advise clients that are married. A lot of times they want to set up a multi-member LLC and start putting properties in it and depending on if they're in a community property state, but I see a lot of unintended consequences of the multi-member LLC as far as from a compliance standpoint. Most of them don't realize those returns are due on March 15th, and now they're getting a nasty letter in the mail. Do you have any words of wisdom for tax pros when, thinking about these properties owned jointly by a spouse?
Yeah,
spouses?
The first one is always check the title because often who people think owns a house is not who owns the house. So double check it's even in that LLC to start with. That's like your get out of jail free card. Is maybe they didn't actually put it in there.
Right.
The next thing I look at is the LLC. I think it's often that people think it was both of them and it might have been one or vice versa. So I always double check that. If they actually have a house in an LLC they're both on, your next sort of out of jail card is going to be, like you said, a community property state. If you're in a community property state, even with a 2-person entity, you can opt to have it treated as disregarded for tax purposes.
Right.
So you've got that option there where you could keep it on their personal return. If all of that has happened and we have a partnership, well, at this point, we've got a whole lot to worry about. If it is past the due date and they didn't know they had a partnership and now that return is late, there is a rev proc that you can sometimes use for late relief on a small partnership as long as there's some criteria met. So that is something to be mindful of as well in case we sort of missed the boat and the boat sailed. We might be able to swim out to it on a little life raft, pull it back in.
So look into qualified joint venture potentially treatment. Look into that first time or one-time abatement. What I call it the get out of jail free card also. And I'll tell you, there's so many times where I just had a meeting with someone today that's a potential client. They said, "Yeah, I formed this LLC, but we never put the property in it." So basically, they have this dormant entity with absolutely no activity. So really, the property's owned should be put on 2 personal returns on Schedule E. It was him and his dad. So it's funny, which actually is kind of good for him from a tax perspective, from a compliance perspective. So, in kind of my final technical question is, this is another thing that I think that I see people get feisty about. And I know that there's a difference. You can't double dip your hours, right? Sometimes people get confused between the rep status or real estate professional hours and your short-term rental property hours. Can you kind of compare and contrast those just from a 30,000 foot view?
Yeah, absolutely. So they're both being either a qualified real estate professional or meeting the short-term rental 7-day or less rule. Either one leads to the same end result, which is the property can be non-passive. And then there's additional steps. So for real estate professional, at its core, only one person, we can't combine hours between husband and wife or spouses. One single person has to hit at least 750 hours on one or more real property trades or businesses and spend more time on real estate than anything else. That's the one everyone forgets about. So if you have a full-time W-2 job, probably not going to qualify. Secondly, so like I said, real estate professional just means your rental's non-passive, but we talked about it earlier. Even if something's non-passive, you still have to materially participate. So there's a second step of still needing to prove that 500 hours or more in your group of rentals if you want to use the losses. So that's the real estate professional status. On short-term rental, that specific property, it's looked at kind of property to property, not as a group. And on the property, 7 days or less, you also need to materially participate there. So if you are both a real estate professional with short-term rentals, you might have competing hours because you need material participation in your group of long-terms and in your short-term. They're different sort of buckets. And so if you have those two on the short-term, then it is non-passive there. But the difference in hours, they're pretty similar. Just know that for a real estate professional, you can't share hours with your spouse. For material participation, you can. And the hours for your short-term rental do not count in your rental group. If you say I'm treating all of my rentals as one, short-terms are their own outlier, so they've got to stay separate. So you might have separate categories, doubled up hours.
Right. So because a lot of people with rep status like to use the they like to use the rental grouping election, and yet that doesn't count for their STR hours. So each STR property is in its own bucket autonomously. If you have, if you have a short-term rental property with it's one property in a duplex, I mean, that would be one bucket to me because it's on like the same piece of land, but ultimately they're different buckets. So I know we have so many fun situations we could run through, but that's why we're going to tell people about your CRETS program, and you offer opportunities for tax professionals. Because if you're listening to that, if you're not a tax professional and listening to this, you're not even my wife doesn't even listen. I don't know, you must be really like us. But hopefully you're getting your CPE. But Natalie has an amazing program that not only educates you and empowers you as a tax professional, a CPA, or an enrolled agent that needs CPE, but I found that every time I've invested time, energy, and money into continuing education, I make it back multiple times on my value and who you can help out. But Natalie's developed a CRETS program, Certified Real Estate Tax Strategist. Can you tell us a little bit about that?
It's a 10-week deep dive into all things real estate. It is 20 plus hours of IRS CE. And my biggest goal for it is for you to understand all of these things in depth at the end. I talked 2 people out of taking it today because I didn't think they were ready or it wasn't the best time. It is there for you to understand real estate. Investors are begging for professionals who really understand what they do. And a lot of tax professionals are really wanting to learn more about this area of tax. So it's a perfect way to align both of those things. Gives you all of that education, weekly Q&As, ongoing membership for more questions and answers, and client leads. So if you're looking to deep dive into real estate, it's a fantastic way to do it all in one spot.
And get your CPE.
Awesome, you guys. Well, I know we can talk on this. We go on in a million different directions and run with it for a while. So I'd almost pose the last kind of question for you, Natalie. If, this being a show targeted towards tax professionals, say somebody doesn't do a lot with real estate investors. They'd like to. Obviously, you have resources for that. But what are some maybe high-level little tips to give them? Just a couple. Really just to say, you can do this. And, these are a couple things you can do. Maybe just say, no, I don't deal with it, right?
So I think the biggest things to kind of learn about first or focus on if you're going to start doing real estate investors is depreciation. You can't depreciate land. Figuring out land versus building value, that's huge. And really then understanding the common expenses associated with it when it's in service and what is a capitalized renovation versus an expense. Those are where I see the most errors related to rentals. So if you can hone in your skills there, that's where I would start with kind of the easy ones and work your way up.
Great advice, and we so appreciate you being on the show. And John, I know you feel more educated now.
Oh, always. I'm sitting here again and kind of have my sticky notes, right? Can't find my pad of paper anywhere, so I have like 6 blue sticky notes all over the place. My daughter's going to come home from daycare and think that Daddy was doing art projects today. But yeah, obviously, Natalie, let's tackle Chris a little bit too. We obviously appreciate your time. again, to me, not being in a tax pro environment all the time, obviously I do a lot with Chris, so I'm kind of, through osmosis, I hear a lot of stuff and more personal interest. But I can tell you firsthand, going to tax pro conferences, events, being in conversations, there are so many potential clients out there. And Natalie, as you mentioned, they are literally begging. As bad as it is, they'd probably settle for somebody that's not the greatest, but they handle it and understand a little bit. So I'd say the opportunity is there for the understanding. So obviously, we talk about opportunity. We have the resources. As mentioned too, we'll put those in the show notes for Natalie's contact information for that course, but then also some stuff that we have through the Monthly Recurring Revenue Institute. And also, I wrote down a couple of things that we've done with teaching tax flow too, so I'll drop those in the show notes. So lots of homework. If you want it, anybody, it's here. But again, thank you, everybody. Thank you, Natalie, and thank you, Chris.
The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum. The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer.